Welcome to Secrets of the Australian Housing Market Revealed. I'm John Lindeman, a long-time investor in the Australian housing market, a property market researcher and an author on the Australian housing market. I've had many years of successful property investment experience around Australia and over 10 years professional research into the housing market with major data providers. My professional research showed me that no one seems to know what's in store. I found that some were warning of looming disaster, others were guaranteeing wealth, but nobody seemed to be able to explain exactly how the housing market performed. The problem for property investors still persists because you've got to make correct decisions so that you can maximise rent returns and capital growth. You need to know where to buy, when to buy, what to buy and when to sell. I embarked on a quest. My quest was to discover how the Australian housing market works and how investors can know what's coming. I researched the Australian housing market. I spent around 20 years going around every city, every state and territory and looking at every type of housing market. I conducted seminars and talked to thousands of property investors over that time. They continually asked me the same questions. I researched all the theories that there are about the housing market cycle, recent growth theory, past performance theory. And when I'd finished all my research, I crystallised everything I had found out into a book called Mastering the Australian Housing Market. This book was released last year and has been a landmark publication for property investors who really want to know what's going on and what's in store. I also write a monthly article for Australian Property Investor magazine on housing market research. Here are some of the articles that I've been writing towards the end of last year and this year. But today, I'm going to reveal the market secrets to you. How does the Australian housing market work? Well, to know that, you've got to know what the Australian housing market is. Is it houses, cottages, mansions, units, apartments and so on? No, it isn't. The housing market is about people, their purchasing power and the places they live in. Let me explain what I mean by that. Let's look firstly at people. Now, people form households. They start off as singles, they might join groups. Eventually, most of us will end up as couples and start families. As we go through life, our children grow up and we become empty nesters, and then eventually we become singles again. Now, each stage of our life requires a different type of property to live in. And also, as we move through these different stages, our purchasing power changes. When we start off as renters, we have absolutely no purchasing power, or very little, and then when we become first home buyers, we borrow most of the money that we require for that property. We attempt to improve the value of the property by renovation, or we'll use the increased equity that we get over time to upgrade to a better house in a better location. Some of us become investors and use that equity or other income to buy an investment property. Eventually, we become retirees. Now, the interesting thing about this process is that when we're retirees, we usually own all the equity in a house that we have. In other words, we don't owe anything at all. We're not reliant on finance, and our purchasing power is such that we usually downgrade when we buy our last home. What sort of places do we live in? Well, there are many, many different types in many locations, as you can see, and the Australian housing market encompasses all types of residential properties, be they high density in inner city locations, medium density units and apartments, older terrace houses, new suburban, rural acreage properties and resort style accommodation. But how many are there? Well, When you put it all together, you discover that there's 10 million residential properties in Australia. Of those 10 million, 10%, that's 1 million, are unoccupied at any one time. Now this is quite a surprising figure for many people, but when you look at why they're unoccupied, you'll see that many are between rentals, they're being renovated, they're condemned, they're between sale, so they're unoccupied. Some are being redeveloped, but the vast majority of these unoccupied properties are actually holiday homes, and we have around 600,000 of these in Australia, scattered around the coast and the mountains, and they're mostly unoccupied, and if they are, then the principal place of residence is unoccupied. 5% of our housing is public housing, that is provided by the government at subsidised rentals. 30% are mortgagors, that is people are paying off their property, be it their first, second, third or whatever property. They own part of it but not all of it. But 30% of our properties are fully owned, that is to say there's nothing owing on them to the banks whatsoever. 25% of our properties are private rentals, that is they're owned by investors, but it's only 1/4 of the total, and that's a highly significant figure. In order to discover how the property market works, I went back in time. I thought, let me see what's happened over the course of Australia's history, the different events that have occurred, and see how I can work out how that relates to the property market. If you look at this graph, you'll see it goes from 1901 right through to the present time. And over on the vertical column, you'll see property prices. In 1901, the average Australian house was worth around $1,500 in today's money. When you look at the graph, you'll also see that there have been periods of very little to growth or little to no growth, and at sometimes property prices have fallen. But let's look at the growth periods first. That huge leap during the post-war period was actually due to the return of all the soldiers who'd fought in the First World War. They had to catch up, start families, and they were encouraged to buy properties by the governments of the day. So what happened was a doubling of house prices in a few years, extremely rapid house price growth. That was followed by the Great Depression in the 30s, when many banks went to the wall, they couldn't lend, and so people couldn't buy homes. New households had to rent. During that period of time, the price of houses actually fell by around 20% over 6 years, but rents skyrocketed. Then we had another post-war population boom, and this one again resulted in a greater than doubling of house prices, and it was only 2 years to double, and that was what we call the baby boom period. You'll notice after that house prices didn't go up at all, and we'll explore the reasons for that later. Since then, we've had a period of fairly, what appears to be, regular house price growth of around 9% per annum. And a lot of housing market theories are based on that performance, that house prices double every 7 years. But what the graph doesn't show you is the extremely high inflation that occurred in the 70s and 80s and caused that 9% growth. So it's misleading to say that property prices double every 7 years. They do not do so, and they may double in less than that, as they did during the post-war booms. They may not increase in value at all, as they did during the Great Depression. And the trick is to know what causes these events. To get a better idea of what was going on, I looked at housing rents, and I indexed them up to the price of houses so that I could compare one to the other and look at the relative movements between them. So the red figure, which is rents, shows you that when house prices boomed after the First World War, rents actually fell. It seems logical when you think about it, because many people moved out of rental accommodation and started to buy properties. Home ownership went up to about 80% at that time. But then rents skyrocketed. Now the first cause of that was that after the war we welcomed migrants into this country, refugees, and these people, when they arrive, have to rent. They can't buy for several years, and so because there was no more accommodation, that population growth and increased demand in rentals caused a huge skyrocketing in rents. That was worsened during the Great Depression when, as I mentioned, no one could get housing loans, many people were evicted from their homes, unemployment went up to 20%. These are a terrible time. It was something that we would hope would never ever occur again. Now, home ownership dropped from 80% down to 45% by the end of the Great Depression, and rents averaged 50% of household income. So even if you could have got a loan, there was no way you could afford to raise the deposit to buy one. After the First World War, again, a rapid increase in house prices and a falling in rents. We now know why that occurred, because people could buy instead of rent, so moved from one to the other. But then you'll see a rapid increase in rents after that period, and that again was due to the influx of post-war migrants, which saw a rapid increase in demand for rents. So you can see that if people can't afford to buy, and if the population is growing, they have to rent. Therefore, either rents go up, or, if they can buy, house prices go up. Since the Second World War, I also looked at the number of years it takes for house prices to double. Now, this graph shows you two interesting things. It's the number of years it takes for house prices to double. So in the 1950s, in Sydney it was 4 years, and in Melbourne and Brisbane it was 5. In the 60s it was 8 years, and so on. You can see the difference, that there is no regularity to this. Some years you'll find that it takes only a few years for house prices to double. In other occasions, like the 90s, it would take well over 12 years for that to happen. What you also notice is that it's not regular between capital cities. So that means our housing markets are performing in different ways in different cities. When you hear figures saying Australian house prices fell by 2% or rose by 3%, this is the most misleading statistic, because there is no average overall performance. You can see here that every period performs differently, and every housing market performs differently as well. As we saw in that graph before about the end of the First World War and Second World War, prices tend to occur in short bursts. This is something which still occurs, and here you can see Sydney and Perth's housing markets compared. Now, from 2002 to 2003, the Sydney housing market absolutely boomed, and it nearly doubled in price in a few years. But what happened after that is highly significant. It didn't move at all. In fact, it took 8 years for growth to return to the Sydney housing market. Perth grew from 2004 to 2006, more than doubled in value, and since then has again hardly grown at all. What is that showing you? Well, it shows you that if the growth is higher than the long-term average, it tends to fall back to that average over time. So if you get 20, 30, 40% growth over a year or two, you'll be sure that there won't be that continued level of growth after that. In fact, what will happen is that prices will correct somewhat, and may even correct substantially, as they did in Perth, where they dropped by over 10% following that boom period. But you can also see that it takes time. There's time for you to see, well, the growth stopped, I better sell. There's no point in hanging into a market where growth has occurred and then slowed down, because this graph is telling you that that growth is not going to occur again for quite a substantial period of time. Therefore, timing in the market is of essence. Time in the market will eventually get you that long-term growth figure of 8 or 9% if you include inflation. But what you can see here is that you can do far, far better than that as an investor if you buy in the right place at the right time. Growth is short and sweet, and it's highly selective. So how can you know what's in store? Well, I had discovered the Holy Grail. Through all the research that I did, I knew what the causes and nature of demand were, and they were very simple. Population growth generates demand, and it's the cost, availability and need for finance that determines whether this will translate into rental increases or price growth. That's the simple fundamental of the Australian housing market. Let's look firstly at population growth and change. This graph shows you Australia's annual population growth rate. On the left is the percentage change every year. Across the bottom are the years from Federation in 1901 all the way through to the present. Here again you'll see the huge growth in population that occurred after the First World War and after the Second World War. We've never had population growth anything like it. It was caused firstly by the return of the soldiers and a boom in the population from babies, then followed by the welcoming of migrants and refugees and a boom in rental population demand. So you can see there those two spikes. But what you also see is that even during the worst years of the First World War and the Second World War, our population growth was still positive. Zero is along the bottom. We've never had a reduction in population in Australia's history, and that is highly significant for the Australian housing market, because if you have increased population, you've got increased demand for housing because everybody needs to live somewhere. When you compare our population growth rate to that of other countries, you find even more fascinating statistics. Australia has got the highest population growth rate of all Western countries. Track across from Australia with its 1.6% growth rate, you'll see USA, Canada, United Kingdom, New Zealand. You'll see Asian countries such as China, whose population growth rate, although the numbers are far greater than Australia, the growth rate is only around 0.6% per annum. Even India at 1.2% is lower than Australia's. In fact, many countries over on the right, such as Germany, Japan, Greece and Italy, have falling populations. This is highly significant for their housing market, but it's not a good significant figure at all, because what it means is if you've got a falling population, you're going to have a reduced demand for housing. Therefore, you'll get housing surpluses and house prices will fall. Not only that, but because people aren't having babies, it means that the average age is increasing all the time, and that means that the demand for the type of housing will change from 3 or 4 bedroom family homes to 1 or 2 bedroom condominiums in inner city locations. The other factor is finance, the need for availability and cost of finance. We saw that first home buyers need to borrow all of them, virtually all of the purchase price of their first home. And as you move through the various stages of property ownership, your equity increases and your need for finance and dependence on it reduces. When you get to the point of being a retiree, you probably not have any need for finance at all. These two dynamics create different types of housing markets in Australia. Let's look at some of them. Firstly, first home buyer markets. For houses, these are outer suburban areas of our major capital cities, and for units, they're along transport and infrastructure corridors. The average price, the average first homeowner loan is around $330,000, so that gives you an idea of the price ranges for these properties. Being entirely dependent on finance, it's the cost and availability of finance and the relative cost of renting that determines when aspirational first home buyers become first home buyers. If we have a period of reducing interest rates and government first home buyer incentives, then the first home buyer market booms. This then has an effect on upgrader markets, because when first home buyers buy, every home they buy means somebody else is selling and using the increased equity that they've got to upgrade to a better house in a better location. So you have a sort of a ripple effect which moves through the market. Many housing booms in Australia have been started by first home buyers, but not all of them. Some booming housing areas are associated with mining towns. Here the dynamics are completely different. It's all about the demand for the mineral and the policies of the mining companies. Increasingly now we're seeing fly-in, fly-out, drive-in, drive-out labour policies, and this is affecting where the workers live. In some cases, mining companies are flying workers in and out from places like the Gold Coast or Sunshine Coast to work in the coal mining towns of central Queensland. In others, increasingly they're looking at accommodation in Perth to house workers when they're rostered off from places such as Dampier, Crathra and Port Hedland. So mining towns are not just about the actual mining town itself, but about the dormitory towns and the ports that are associated with them. Retiree destinations located around our coastline form another housing market where economic conditions play very little, or what you might think is a little influence on their market. In reality it does. What happened during the global financial crisis was that many people approaching retirement put off their retirement because of the cuts in superannuation and the share market that had occurred. They decided to wait things out and see what would happen. By now they've probably realised they're not going to get their share market investments back, and their superannuation funds, which also heavily rely on the share market, will not return to where they were back in 2007. Therefore, they're going to start biting the bullet and retiring. Where will they retire to? Well, to pristine areas not too far from our capital cities. These areas are about to boom, and the trick is to know where they will boom and when. What happens when the dynamics change? The local housing market changes. So it's keeping a finger on the pulse of all these dynamics that enables us to work out what's going to happen in future. In order to do that, I developed a property power database. There are 10,000 suburbs around Australia with houses and units, so I got all the data I could about the demand indicators for those suburbs, population growth and change, finance trends. I looked at the housing prices, rents and the demand and supply trends for both houses and units in all of these, and then track them over time to work out what the trends are. And that enables us to forecast rent and price very accurately. This database is a unique storehouse of information about the Australian property market, which is specifically designed to predict and forecast rent and price changes. How does it work? Well, firstly we look at the rental market, and each suburb has a relationship of intending renters to investors. If you know what that is and how it's changing, then you know whether rents are going to be falling or rents are going to be rising. For example, if in a renter market, what you find is that there are too many properties for rent and not enough people wanting to rent them, and so rents will start to fall. In investor markets, the opposite occurs. It means that there's a shortage of rental properties and there's more and more people wanting to rent, and so rents start rising. If you know what those numbers are and what the trends are, then you know which way rents are going to go. The property power database has this information and predicts these outcomes. You also need to know the relationship of intending buyers to sellers. We look at each suburb in terms of 5 dynamics. Is it a stressed market? What does that mean? Well, are there far too many properties on the market listed for sale and not many buyers? Well, if there are, that means that prices are falling. At the other end of the scale, you've got a boom market where everybody wants to buy and there are very, very few properties for sale on the market. In such an environment, prices will be rising and they'll keep rising. But somewhere in between is every single suburb in Australia. Most of them are not stressed, most of them are not boom markets, and so you need to know the relationship between potential buyers and intending sellers, because that'll tell you whether prices are likely to fall or prices are likely to rise. And you also need to know how that's tracking forward into the future, in other words, what's going to happen. You've got to know where prices are at their lowest, where they're about to rise. Know where rents are about to rise. And you need to know when prices and rents are about to start falling so you can decide whether or not it's time to sell and move somewhere else where they're about to rise. Well, how can you do that? In our Property Power Report, we provide you with up to 20 suburbs. We decide on these suburbs, or you do, by the type of housing. That is, are you interested in housing investment, a house or a unit? What sort of price range are you looking at? and what locality. Is it a particular capital city, a locality within that city, a regional area? Do you have an interest in a particular type of housing market? It could be first home buyers, it could be retirees, it could be a mining town, for instance. What we give you is information from the database for up to 20 of those suburbs. This is how the information is summarised. In this case, the investor was looking at northwest, the Hills district of Sydney. There you see the number of suburbs on the left, postcodes, what are the current weekly asking rents in each of those suburbs. What's the median of listed stock asking prices? In other words, what are the sellers asking for their properties? What's the median of that, the middle point? Then from our database, we calculate what the rental stock forecast is. Is there a shortage or a surplus of that type of property in that area? You can see in Baulkham Hills there's a shortage, and what that means is that rents are likely to increase. Then we look at the current housing market. What type of housing market is it? What is the relationship between buyers and sellers, between potential buyers and intending sellers? Well, Baulkham Hills at the moment is a seller market. What that means is that it's good for people who want to sell. Prices are rising, probably have been rising for some time. The housing prediction, however, is telling you that it's moving to a buyer market, which means that it's good for buyers. Therefore, prices will stop rising. So if you had an investment in Baulkham Hills, you'd be looking very closely to see what that trend is telling you. Each suburb has a different current market and predicted market, and it's that relationship that tells you what to do. The third one down, Carlingford, house prices, it's a seller market, they're rising strongly, but it's going to be a boom market, therefore they will continue to rise strongly in future. No need to sell there if you had a property. We do far more, however, than just summarise the market in this way. We provide you with a complete range of statistics for the rental side of things. What are properties renting for? What's the current private rental demand? How does that compare, the supply compared to the demand? In other words, is there a shortage or a surplus? Roughly, how much is that? How much have rents changed over the last year? What's the rental yield? That's the median rental yield for the area. And what's the stock forecast? Is there going to be a shortage, a surplus, or a balance? All that information is made available for you, so you can see what's going to happen. We do the same with the buyer-seller market, and in here we tell you the change in buyers over the last year. You'll see that first coloured column shows you the percentage change in buyers. In Baulkham Hills, the number of buyers has dropped by 14% over the last year. The next one is the change in listings. How many potential sellers? Well, that increased by 20%. The colours show you the relationship of each of the suburbs to each other. In other words, red means it's one of the worst in the area, green means it's one of the best. So when you look at Carlingford, you can see green for buyers, green for listings, and that's why over on the right you can see it's moving from a seller to a boom market. So the colours indicate the type of market for you. Listings compared to monthly sales, that column is roughly equivalent to the average time on market. You can see there how long it would take an intending seller to sell their property if they left their price as it was. So it gives you a good indication as to how quickly properties are moving in that market. The listings to sales trend, what that shows you is how is that monthly figure moving. Is it going up or is it going down? If you find that the figure of listings compared to sales is high, that means it takes a long time for properties to sell, and the percentage is increasing, that is not a good market to be buying into. And you can see how in Beaumont Hills it's moving to a buyer market, which means it's good for buyers, not good for sellers. In Carlingford, that trend is dropping by 18%, which means the time on market is actually going to shorten and it's turning into a boom market over the next few years. All of this information is provided for any area that you wish to have information for in Australia for any price range for houses or units. It will show you where to buy and when to sell. It'll tell you whether rents are likely to increase or decrease. And it's available for any type of housing, units or houses, for any locality, city, regional, country, for any type of market. And it's in your preferred price range. So what you're getting is 20 suburbs in your price range. It'll tell you what they're about, what they're doing now, and what they're about to do in the future. How they're predicted to meet your property investment goals for rent and growth. These property power reports are available through Investors Edge. We're very happy to be associated with them, and we're very happy to have brought you this presentation on secrets of the housing market. Thank you very much, and goodbye.